Muy buenas tardes. Gracias, Tony, su hermana, Magdalena, y Presidente Fox, que me invitaron a esta conferencia. No puedo exprimir como quiero en español, entonces I'm going to change into English. I hope that's okay. You all speak such beautiful English. It's very shaming that I cannot speak as well as you in Spanish, but que lástima. What I'd like to try and do today is to share a little bit of my experience as a venture capitalist. This means I'm an investor in many, many startup companies. Today our portfolio has, I don't know, about 70 companies in it. Some doing better, some doing less well, but it's a portfolio. And for our investors, we try and return outsized returns for their investment in our fund. That means we need to be investing in high margin, high growth companies. It seems to me that many of you are family owners of large companies that are existing incumbents in various Latin American countries. And what I want to try and bring to you is a little bit of opportunity and danger that confronts you as you go forward into the future. The digitalization, the virtualization of the world, the movement from material toward services, toward IP, toward intellectual property value is moving at an accelerating pace. And I think you have both opportunities and threats on the horizon. Just a few questions. How many of you operate what I'd call traditional businesses, industrial, services, more the traditional style? Yeah? Okay, maybe about half. And then how many are you more in the technology side, the higher tech? Okay, so a good mix. Okay, so this is not a lecture. I'd like some questions, so please, if you want, go ahead and ask questions, and I'll leave some time at the end as well. First, we'll start a little bit about Blumberg Capital. My firm is an example of what we do, how we win, how we fail, and then maybe some lessons from the bigger world, North American world, of big companies that you've all heard about, and then maybe lessons here that are more specific to Latin America and how you can make your businesses strengthen and grow into the future. So first, the title of this is intentionally vague: adopt, or ... and you'll see what comes next. Okay, let's go. Sorry, this is the clicker. So Blumberg Capital is, I think, similar to many early-stage venture capital funds. Our mission is to try and help entrepreneurs grow their businesses, to scale them, to make them into large, huge companies. That is really what our goal is to do. So we come in very early. We usually invest at the seed or A round. That's the first institutional investment period. Our investment range is usually a few $100,000 to $5 million on the first check. International access, we try and invest in the best teams. So sometimes we're investing in the US. We've invested also in Israel, Germany, Canada, and India, and Japan so far. We try and help those entrepreneurs, wherever they're from, have access to the major markets. So the big partners in Silicon Valley in particular, Facebook, Google, Microsoft, IBM, et cetera. All these companies are very important partners in general. And then we also help them add management team, talent, because many of these companies are started by 3 or 4 engineers, and they need a head of sales, they need a head of business development, they need a CFO, a chief financial officer. We help them recruit those people at no cost. We bear that ourselves. We also help them with business development, introducing them to potential acquirers, potential investors, potential customers. I've talked with a number of you about our portfolio companies, and if you have large existing retail network, for example, some of our companies that do price optimization may be of interest. So we love to make these kind of connections to help you and to help these companies grow faster. At a glance, our firm has, and we're, again, small, but I think average, 5 investment professionals in San Francisco, 1 in New York, 3 in Tel Aviv. We focus only on capital-efficient businesses. So you would never see us investing in an oil refinery or a timber operation. We do mostly software. It's very high margin, can grow very fast, and this is what we call capital efficient. Hardware is starting to become more capital efficient, so you're starting to see very exciting new developments in the areas of 3D printing and other types of hardware that was never easy to do for a small fund before. Now it's possible on more limited budgets, and so we're exploring those areas. We, again, lead early stage. We invest in innovation hubs. There are some developing in Latin America. We're open to that very much. We've looked at a few deals, mainly from Colombia, Mexico, a few other places. Many of our companies have outsourced operations in Costa Rica, Argentina, Brazil, where developers are working here. And then there's trade, of course, and we try and help these companies very much grow. Our deal flow is quite astonishing. We're a small firm. We see about 4,000 business plans per year. And a large firm might see more than that. Of that, we only invest in maybe 12 companies or 15 companies a year. So 4,000 down to about 12. It's a very tight funnel. It's very difficult to get venture capital. It's not for everyone. And then our strategy, to make it graphic, really is to go early and go big. Or in America, we say, go early, go big, or go home. We own about 15% of a company on average after dilution and so on of multiple rounds, and try and serve on the company boards. Almost always we're on at the beginning. This is just a little bit of results of recent funds. Fund 2 was 2008 vintage year, and so far you see the amount of the fund was 91 million total in commitments. We've called almost 100%, 97%. We've returned already almost 80%, and the markup is about 3 times the growth of these companies. And I don't take a lot of credit. As a venture capitalist, I think it's very important to be very modest. We like to say that the entrepreneurs, most of you entrepreneurs, you drive the Ferrari. We're the pit crew, to use a NASCAR analogy. We are the ones that help fill your gas, fill the oil, change the oil, fix the car, clean it. You're the one who's driving the car. We're there as a minority investor to help you grow faster than you could on your own. The next slide is, next slide. The next point is on Fund 3. That's a newer fund, only 4 years old now. It's already had 1 exit from a company that sold within 20 months of our investment, which is very rapid return. And it's also doing nicely. It's already 1.5 times the capital invested so far. Okay. This is very much a hits-driven business. And our biggest hit so far is a company in recent times called Nutanix. This is a company that does converged infrastructure or virtualized storage. And it was 3 immigrants from India who came to Silicon Valley. One worked for Google. He saw how Google was able to do what they call web-scale architecture. They didn't buy heavy equipment from large, big vendors, not picking on anybody in the audience, but they didn't buy from folks like EMC and others. They decided they would do it themselves. Instead of buying expensive hardware and software combined, they'd buy commodity hardware and put their own smart software on top. And so at Google, this engineer got the idea, let's do that for everybody else. Let's bring web-scale architecture using commodity appliances for the storage market first, and then moving on increasingly to other sectors of networking. So this little company, we invested $3 million over 3 rounds, seed, A, and B. After us followed some of the most famous names in venture capital, Vinod Khosla, Lightspeed, Goldman Sachs, Morgan Stanley, et cetera, all at higher rounds of pricing and as the company grew. When we invested, the company had no product, it had no revenue, of course, and only had 3 employees. Their business plan was basically a slide deck. So that's how early we'll go in. But we believe that the team was superior. We believe that their target market was huge and that the need was there. We have something called the CIO Council, Chief Information Officer Council, where we have Fortune 500 CIOs, Chief Information Officers, from various large companies like Thomson Reuters, WPP, airlines, GE, et cetera. And they get together with us 4 times a year, and we ask them, if we build this, will you buy it? And if there are enough thumbs go up, then it makes a good investment decision for us. So we invested in this company very early, again, no product, and that was about 8 years ago. Today, the company is worth, between who you ask, between $2.5 and $3 billion. When we invested, it was $8 million. So I'm just showing this to show you the incredible power that some companies can grow so fast these days. It's quite astonishing, and it's due to some changes we'll talk about in a moment. The way we sell, SaaS model, et cetera, and this very lean capital model. Here's another one, Hootsuite. This is a company that some of you may know because I think it's reasonably popular in Latin America. It's a company that had, again, 0 revenue when we invested. They do social media management dashboards. So these are dashboards that help marketers manage multiple accounts of Facebook and Twitter and LinkedIn and so on, many social media networks, all managed one time with different time zones, different languages, and it's really an efficiency tool for marketers. This is a company, again, it had 0 revenue. The interesting thing about it was it's called what's called a freemium model. So they gave the product away for free for most people. When we invested, I think they had about 150,000 users for free right now, then. And then they started to add functionality and charge small and medium-sized businesses $10, $20 a month. And then they added to that, and it started to expand till they could charge now hundreds of thousands of dollars a month. And they have customers now paying well over $1 million a year. Hewlett-Packard, the White House, big companies like that. And so this is an example of this freemium model where they start off free, find the value proposition that works with the market, then they start charging more and more for those who can pay more and more. And it's grown enormously. We sold some of our shares in a transaction which is an interesting adaptation to the market. Many years ago, early stage venture capitalists really did not have a chance to sell until the final exit of the company. But what happened in the last, say, 10 years is that the IPO market moved later stage for a variety of reasons, mostly regulatory reasons, something called Sarbanes-Oxley rule in the United States after the Enron crisis and others. Congress legislated changes that were tried to root out corruption and so on, and accounting fraud. But that was nice, but unfortunately, apples still rot in every box. There's always going to be corruption in a certain amount of companies. But what it did is it raised the cost for everybody. So a lot of companies that used to go public very early in valuation of 100, 200 million decided we're going to wait because the cost of the legislation for legal and accounting advice required them to take so much out of their earnings that it was a huge cut on their valuation. So they decided to wait. So you see companies like Facebook and Twitter wait till they're worth billions and go public much later. Now, that was bad for certain things, but it was good for another. In our case, what it allowed is us to do secondary sales. So partway through the growth of these companies, when we had a 50x on our money already from Hootsuite, we were able to sell a portion of that to return it to our investors and keep the rest to ride through to see if it reached even larger valuation. So that gave a nice flexibility to early stage investors. And Mr. Rivera was talking about private equity. They're usually later on the stack. We're the earlier. So sometimes now our companies are able to sell part of our shares to later stage growth investors, maybe like his group or others. And that's new in our world. And it also allows for liquidity for entrepreneurs. What's called a secondary can also be used for an entrepreneur to buy a house, for example. They might need a couple $1 million in the Bay Area to buy a house, and they might be very rich on paper but have no real capital of their own from the startup. But it's increased in value, so they can sell a little bit in the secondary, have enough money to, say, buy a house or put kids in school and so on. What I want to show here is 6 of our top companies, but just this is for an example. And the reason I say this is that many people say, oh, but David, there's such a huge valuation bubble. A lot of these companies, Nutanix, Hootsuite, they're just high valued because they are, and the market is crazy. Well, the difference between now and, say, the 99-2000 bubble, which was a real bubble, and I'll show you some slides on that in a moment, is that these companies all have real revenue, very rapid growth by historical standards for companies to grow to. All of these companies are no more than, 5, 6 years old, 7 years old, and they've all grown to over 30 million in revenue, some to over 300 million in revenue in that same 8 years of time frame. That's very fast by historical standards. And this is just 6 out of our 70 companies. So what I'm showing is it's real revenue. In contrast, in 99-2000, there was a great run-up of valuations in Silicon Valley, high valuations of companies, but very little revenue to show. We used to say that the model was not chasing revenues and dollars, but chasing eyeballs. We wanted to get people to watch our portal or subscribe to our company's website, but no real revenue. These companies all in general have real revenue. And most of them sell B2B, business to business. The first wave in the internet was often to the consumer directly. Here's another one, and this shows another trend, which is very rapid technological evolution. It's especially notable in the cybersecurity space. This is a company called Cyvera. We invested, and 20 months later, the company was sold. We invested at $6 million, and it was sold for $200. So it was quite a good gain in 20 months. It was not our plan. We're not short-term investors. We were ready to hold that company, let it grow, and supply it with more money for 5, 7, 8 years. But they got an incredible offer. Management was going to have a life-changing event for each of them. They were young guys, not much out of the Israeli army. None of them had owned a home, and this was going to be $50 million to each of them. It was a life-changing experience. So we were supportive, and it sold, and of course our investors were happy with an early return. But I think the important point is that cybersecurity is an example of what's going on in technology. Cybersecurity is unusual in one way in that it's a cat and mouse game. There's a new platform, and we find new holes. And it needs a new repair, and the new holes are found in another platform, and new holes, and new repair, and so on and so forth. So it's a good thing for venture capitalists in a way because it's constantly the ground for new entrepreneurs to start things. The big incumbents have difficulty keeping up with the latest bugs and the fixes, and so it's often new companies that create the new great companies. This one was for endpoint security, and I think the key point of why they wanted to sell partly was that they would have had to develop a whole distribution network, salespeople, marketing, customer service, all of that, and instead they were able to sell to Palo Alto Networks, which already was public, already had a lot of this infrastructure, and their product was able to just get right into that and go to market. Okay, now here is why change is happening at the mass scale so rapidly. Look at this, the Fortune 500, oops, sorry, I didn't want this one, I want this one. The Fortune 500, only about 12% are left 55, since 1955, or say 60 years later. That's pretty amazing. Most people think, oh, they're so stable, the Fortune 500. They're the big, strong companies. But change is happening very fast. And some of you, I think, own some of the Fortune 500 of Latin America. So my point is not to scare you, but I have to. Because I have to say, you cannot sit on your laurels, as we say. You cannot rest on complacent saying that it's going to be fine. We know everybody in the government in our country. We know the rules. We know the people. We know how our consumers buy. Things are changing really fast. And I'm going to give you some examples coming here. But it's also an opportunity for you. Because most of you have excellent educations. I've talked to everybody here. You've gone to Wharton and Harvard and Stanford and so on and so forth. And you have generally capital, and you have a base. You have business backgrounds. So this can be leveraged very, very well. But I think it's going to change a little bit of the way you've done business in the past and will do in the future. Note that there's growth opportunities. 55, it was 136 billion in revenue combined. Today, 12.5 trillion. And it's going up. It's going up, definitely growth. There's a lot of growth ahead. The world was a very poor place. The average GDP, I don't know exactly, but in 1955 was probably, I don't know, a couple $1,000s. Today, the world GDP per capita is about $10,000. So the world is getting richer much faster than ever in history. Good thing, more people have the ability to buy smartphones. I don't have it with me, but everyone has one in their pocket. Every smartphone has more computing power on it in your hands than sent a man to the moon back in Neil Armstrong days. It's amazing, the technological change we're standing on the shoulders of giants that have come before us and given us this great legacy. Okay, so this is, enough for that slide. Now this is why, 2 points here. First, let's look at the, I'm going to use this again. Let's look at the bubble. This is the 2099. That's a real bubble. And most of that was valuation going into what they called exuberant, what was it? Something exuberance, irrational exuberance. Multiples just go up and up and up. There was not a lot of earnings, and so if there was a shortage of supply and demand, the valuation just had to go up. So these were very crazy years. Here we had, I believe, $100 billion invested in venture capital in 2000, whereas 2015, we had about 59 billion. So there was a lot more venture capital invested then. There were 2,000 deals done that year. I think there were maybe half of that this year. So again, numbers are much more rational, even if we're at a bubble. And this, I'm sorry, these slides are a little bit old. This is 2013, so it probably goes above the red line in 2015 and starting to get down again now in 2016. Another important thing to note here is the rise of technology as a segment of the GDP of the world. Remember, let's start way back, 200 years ago from the American Revolution, 1776. I know the statistics here, I don't know it in Latin America, but in 1776, 95 or more % of Americans worked in agriculture. By the Civil War, about 20% were in services, 40% in industry, and 40% in agriculture. Today, 2% of Americans, US Americans, work in agriculture. 2%. It's astonishing, but we produce much, much more food, about better quality, we live longer lives, et cetera, et cetera. So all those people lost jobs. So a lot of you will be hearing the arguments from economists, from mostly populist politicians that say to you, oh, but we're going to lose jobs with all this technology. Well, we've done it before. We lost all those agricultural jobs. People moved on to factories. We lost all the factory jobs. We moved on to services economy. They can be better. They don't always going to be better. We have to be resilient and vigilant about how we train people. And I loved Professor Cuervo's presentation and Mrs. I think it was Sanchez, the young lady trying to train. And I would encourage all of you, kids should get as much technical education as they can. That really is the way of the future. They're going to be advantaged if they have more technical knowledge. And it's a good thing for Latin America because Latin America has a very young population. Asia, people all think, oh, it's great, and it is great in Asia, but Asia is very old. Japan and China and Korea and Singapore and Taiwan are all declining or at least stabilized in population, and they're getting old very fast. China's already peaked in its workforce, the number of people. In Japan, more people die every year than are born. It's really kind of catastrophic for those societies. Latin America is very different. You have still a real pyramid that's growing, that's good, and young people, guess what? They know more about the modern technology that's important than the older generation. You guys are, I think, mostly younger than me, so that's a good thing. But your kids are cyber natives. They go online, they know it. I mean, I see my kids, they know the mobile phones better than I do. So that's a very good thing. Young people know more, and so those kind of jobs will go toward them. But this is important if you're also thinking as an investor. If you invest in mutual funds and indexes to the public markets, then your portfolio has probably kept up. As the market's gone up, you have an increasing percentage of portfolio companies that are in technology. But in the private sector, not so much. If you're not investing in venture capital, if you're not in private equity, you're probably not experiencing that growth in your portfolio. So if you want to participate in that growth in the private companies, there is a need to get into somehow private companies, either directly or co-investing or with venture funds or on your own. Let's go to the next one. All right, now here gets the scary part. And I was going to start by saying adapt, adopt, or adios amigos. It's a scary world. It really is. We've seen companies that have come from the biggest companies fall to absolutely nothing, totally bankrupt in a matter of years. Very, very quick. A few examples here, and you get the picture. Blockbuster on the left, totally outflanked and outplayed by Netflix in less than 10 years. Here's the market cap of, excuse me, starting here. This is not, they went public before this, but this is Blockbuster, peaked at around 5 billion valuation, their IPO, sorry. Wait, that says Blockbuster, yeah. This is their market cap at an IPO, but prior to that, I think there was even higher. But here's little Netflix coming along and just not only surpassing, but far, far larger now. So the market expanded enormously, and this is very common. The market for mainframe computers was X. Mini computers was larger, but at a cheaper price per unit. Obviously, micro PCs, larger market, smaller price per, and then the phone, smaller price yet, and a huge, much bigger market than even PCs. So that's the kind of net point here, is that the new markets can be even bigger. They're usually coming from within your own industry, but they're often for the low end of the industry. And so this is a lesson, again, maybe for Latin America. You might think, oh, we have to watch what the North Americans do. We have to watch what the most expensive people in New York are doing. Not necessarily. The people who were buying PCs were using them for games and little childlike things in the first days of the micro PCs. But those became much more powerful as technology advanced. Moore's Law, the hardware got better and better, and that became used for spreadsheets and then for pretty much everything we do in businesses today. So that looking at the edge market, looking at the lower end markets, often has great opportunities. Next one. Oh, by the way, let me just go back for a second. The things are not fatalistic. Even if you own, say you own the Blockbuster of Argentina for years, and you were faced with some of these changes that you saw coming from over the border. Well, the CEO, Mr. Antonico, tried to change course. At a certain point, their business model became heavily dependent on penalties for people returning the video late. $500 million a year in their revenues was coming from finding their customers. Not a good business model to be penalizing your customers for a major part of your business. You know what a Net Promoter Score is? Net Promoter Score is this ranking that people have on how they're happy with the vendor. banks are generally rated very low, and Apple is rated generally very high. And so on a Net Promoter Score, a business model dependent on when you penalize your customers is not going to be endearing to the customer. So people were looking for a change. And it became much more convenient when Netflix started to offer first a subscription by mail, and then it got much easier with the internet broadband so people could deliver it without sending things back in the mail. But this CEO, around this period, around 2003, 4, 5, tried to change model. He said, I don't want to find my customers anymore. We've got to change this. We've got to move on. But he was intercepted before the board meeting, and one of his lieutenants sort of ratted him out. And he was told, no, we're not going to do it. And then he was fired for trying to change the model. He tried to adapt and take more of the Netflix model, and he was fired for doing it. So sometimes the board of directors can be the problem. I see this as an investor. Sometimes the entrepreneur knows what to do, and the board of directors is so dogmatic and so controlling that they push them the wrong way. So be careful who you take money from. That's another important lesson. Next one, whoops. Here's another famous one, the grocery stores. Okay, so back in the 19th century, it was specialty shops. A specialty shop for baking, for butcher, for produce, etc. That moved into the 1950s. We had the growth of the supermarkets in North America. Huge change, Safeway, Kroger's, Albertsons, you probably know some of them. Then Walmart started going with these super centers. Sam's Club was first in the 60s and 70s, and they grew to become, I think it was started in 62. By 2002, 40 years later, they were the largest company in America. $220 billion market valuation for Walmart that day. And today, it's Amazon. Amazon now has a bigger market cap than Walmart and rising fast. And here are the numbers. The red is Walmart on top, okay? The green is the grocery stores, sort of, I don't know, the top 20 or something. And the blue, which just is amazing in its growth, is Amazon. And this is showing the on-demand economy, this change. Netflix did it by virtualizing, why have stores when we can just deliver through the internet? First mail, then email. And now Amazon is saying, why go to the grocery store when you can order from home? So this is really changing things very quickly. Okay. Phones, Nokia. In 2007, Nokia made 50% of the profits of all the mobile phone market. 2007, that's less than 10 years ago. And today, they're almost nothing. I mean, look at Apple. And Apple wasn't even a phone player. If you would have said 10 years ago, oh, the next two big phone companies are going to be Google and Apple, most people would have laughed at you. So sometimes change comes from very strange places. You cannot assume what was will be. The change comes from really unusual places. And obviously, again, the market grew much bigger than ever with that addition of certain form factor. One interesting way of looking at it is that Nokia felt everything was about hardware. Apple saw hardware and software as co-equal. And some people would say that Google thinks that software is superior to hardware. And so you have the Android, which doesn't have per se hardware, but it has a spec that anybody can develop on. So interesting, different models. All right. And then speaking of Google, the telephone book. Somebody was just talking to me about that over lunch. But this is completely pretty much obviated by the Google search. Whole industry, hundreds of millions, billions of dollars were spent by private equity firms buying telephone directories, which they thought were super cheap, at a time when telephone companies were selling them off, only to find that it completely went to almost to zero with the advent of Google and other search engines online. And then finally, this one. The numbers are amazing. I just want to quote them because I couldn't even believe it when I read it. In 2014, the market share of Uber in its major cities in the US was about 9%, and taxis were about 52%. Okay, 2014. 1 year later, here it is, hold on one sec. Uber had gone from 9% to 29% of the market, and taxis from 52% to 35%. That's dramatic, in 1 year. So this is where things seem to be going. Somebody talked to me about their family, I think it was a great-grandfather, starting one of the great importing companies for automobiles in Central America. And I said, I've seen an interesting study that you've got to think about. And that study talks about the Uberization of society, or the car-sharing potential. And I was at a conference, actually, at CTEC. President Fox invited me to speak there. And they had such famous people that I got put on a panel that I didn't know anything about. It was transportation of the future, because the famous people were speaking on the panel that I wanted to be on. And so I sort of said, gee, what do I know about transportation? Well, let me just ask the audience some questions. And first, a lady from Ford spoke to me, or not to me, to the audience, about the car of sustainability of the future, why consumers want a car that's sustainable and green and so on. And then a man from Delphi Auto Parts spoke about the connected car of the future and how it's going to be interconnected to every device and every service that you ever want, from weather to radio to insurance and so on. And I came up and said, okay, you've all heard about the car of the future. Now let me just ask you, and I'll ask you the same thing, I'll ask you the same question. It might be a little different in this audience, but if I could say to you, transportation should be, and then you answer yes, or one or the other, this hand or the other hand, should be a product that you own. You have to fill the gas, you have to store it, you have to depreciate it, and it's available for you, but you have to drive it and park it. Or should transportation be a service? It comes to you when you want, in the shape, color, size that you need at the time. You don't have to fill it with gas, you don't have to change the oil, you don't have to fix it. Somebody else does all of that. You pay for it when you need it as a service. Which would you rather have? Product that you own, maintain, hold, or a service? Can I have a show of hands? Let's do product, service. Okay, you're not as brave as the other people. It was like 10%, 90% in that audience. And so I simply turned back to the people from Ford and Delphi, and I said, I think the consumer is speaking very loud and clear. There's a fundamental change. People want more virtual society. They don't want to necessarily own a lot of things. They want the value, they want the service that those things bring to them, but it's not necessarily the traditional way that our grandparents and our parents and we have known. So this is about Uber. Okay, now that was scaring you a little bit. Now, why am I so excited to be here? Should you still be excited to be young and to be entrepreneurs? Whether you've inherited a business or you've started a business from nothing, is still the best time ever, as Mr. Rivera said as well, to be an entrepreneur. It really is. I think this is particularly true in technology, but I think it's generally true as well. First of all, the decline in capital expenditures to start a company, especially in software, has never been better. This is things like the cloud infrastructure. Some of you work in cloud sales, and you're saying that it's starting to get good adoption across Latin America. That's a very good thing. Somebody said, if you don't trust cloud infrastructure for your applications, please note that the CIA has started to use Amazon Web Services. Thank you to somebody in the audience, Hector. And there are other number of companies that have been able to take on forbidden white elephants, people that or sacred cows, I think they say. We could not do web services because it was too insecure, and now governments and major companies are starting to use cloud services more and more. The cost savings is dramatic, and so that's very, very good for a startup entrepreneur. The next thing is distribution channels. SaaS model, software as a service. Many of you know this, but I'll make it quick. The old way was enterprise sales. We had to have expensive salespeople, wear Rolex watches, pay them $300,000 a year. They'd walk over and knock on the door of the CIO, the Chief Information Officer. Please, sir, would you like to buy, usually almost always sir, would you like to buy this big software implementation I have? It'll cost you $2 million, and we're a tiny startup. And most of the CIOs said, no, not interested. Today, with the SaaS model, you can just send it out for free on the network. You try it. Let people try per seat, and they can pay $10. Sometimes it's even free. Like, remember the Hootsuite model? It was completely free to try it. And then if you want the managerial modules or the compliance modules or something that a large corporation needs, you have to start to pay a subscription service. That model reduces the friction in sales dramatically. And so that's been a marvelous aid to the startup entrepreneur. So we get companies now that can sell not only in their own backyard in Silicon Valley, well actually Hootsuite as an example is based in Vancouver. They're about 7 years old as a company and they sell in about 200 countries all around the world. They don't have salespeople in all those countries. It's all done through the net, all by self-subscription, managed with distributed teams. It's quite amazing, but that ability to grow so geographically broad, so fast, is, again, a good sign for you, for startups. And then social media and internet platforms and iPhones and smartphones particularly. Smartphones have changed the game dramatically. Really, really amazing. Then there's the growth of emerging markets. You live it, you know it. Most people in the United States are very ignorant of the international world. We don't understand how fast the emerging world has been growing, much faster than developed countries for the last 2 decades. Europe, Japan, and the US have been slow, and Latin America, Asia have been growing, and Africa have been growing much faster than we have. It's a good thing. You should grow fast. It's a really good thing. We should tell our politicians that we want to grow faster too. And then access to education, both formal and informal. I met some of you who are in paid education here, the private sector trying to fill the education gap. We need that as well in America, both K through 12 and the universities. The university system in America is pretty good. Our K through 12 suffers from sort of discontinuities or big gaps. I think that's mainly because it doesn't have enough competition. And so I'm all in favor of new models to try and let parents choose where they send their kids to have better options for them. Then we have professionalization of angel networks. I imagine a number of you are angels. This is essentially simply a term for individual investors. And it's very important, especially in Silicon Valley and places like Israel with a lot of high tech, that once you've made a significant hit by having a company that's grown and succeeded, and then you sell it and you have a significant amount of capital, then you reinvest and you're giving also mentorship. Professor Cuervo talked about mentorship. That's increasingly important in the angel networks. So the old angel networks in the US were looked on pretty derisively. They were said, oh, it's dentists and doctors and lawyers who don't know anything about technology and they just give you money and it's kind of gone. These angels are different. The angels we work with, and we invest a lot with angels, are very sophisticated. Almost all of them are tech executives, and they have background in the area, and they know what they're doing. They don't have infinite pockets, and they don't have a professional institutional vantage point, but they're smart and they're connected to entrepreneurs. So we like to work with them. It's helped entrepreneurs a lot. And then finally, large companies. Some of you own them or control them. Large companies are increasingly realizing that to succeed, they have to partner with startups. And that's part of the reason I'm so excited to be here, because I would like to foster some of these partnerships with you. And as a venture capital fund, I think we're pretty well equipped to do that, and I'll try and explain in a moment. But basically, we've had delegations just recently, 2 days ago, or just before I left on Friday, we had Bajaj, a huge Indian multinational, multiple billions of dollars of revenue. They're the largest motor scooter makers, I think, in the world. And they also have a finance arm that they've developed out of that. They came to Silicon Valley to meet with us, not just to meet Blumberg Capital, but to meet Google and to meet Airbnb and to meet different companies, Prosper and so on, Lending Club, to understand what's going on in technology. What are the new business models? What are the new ways that they can see to address their markets of India that are in fast change, fast growth mode? We've had delegations from Department of Homeland Security. We've had delegations from Samsung, a group from the Philippines, a big bank, all kinds of groups. And they're coming. How do they find us? I don't know. But they find us, and we say yes, because we're very happy. We want to expose our companies to these companies. We want to help them understand. We want to understand what they're looking for so that we can back entrepreneurs meeting those needs. And it's, I think, a very virtuous circle. You tell us what you're looking for. We'll show you some things that we think are up your alley. OK, next one. And this is maybe sort of my final bit, and I'm going to leave a lot of time for questions because I think this should be more of a dialogue. But this is sort of our model for what we would like to do with some of you. We would love to partner with you. If you have a family business that's doing whatever, there are investment opportunities in these companies, partnerships, acquisition opportunities, or you can just become a customer of them, or just learn. We're happy to just share ideas. And what we are is a filter. We're kind of a net if you're fishing, and we're catching a lot of fish and filtering them to bring the best ones to market. Some of them may be interesting to you. Maybe Internet of Things is of relevance to you. Big data, security, software, fintech, which is financial services, or infrastructure, or others. I just put down the major 6. But there are many areas that even if you're selling, for example, just automobiles at a dealership in a country in Latin America, you might think, oh, none of this is relevant. It's relevant. Payment systems are relevant. The Uberization of society is relevant. Big data to understand. Pricing information, optimization of routing if you're in the logistics business. So many things are fundamentally able to be changed. It's quite astonishing. And we find a lot of value. So the door's open. Come to San Francisco, or we can do a video conference with you. And we love to do that and arrange it. You sort of tell us a little bit ahead of time what you're looking for. We'll list maybe 5, 10 companies that we think of most relevance to you, present them, and if you want to dig deeper, we'll make you a direct introduction. You can talk with them further. And it's not just about investing or that. It's also about sharing ideas. We'll learn from you things we've never even thought of. or we didn't know about. Maybe there's some great opportunity in an emerging part of Latin America that we should be open to, and you'll tell us. So those are very useful things. We call it karma in Silicon Valley from the Indian, where we put out something and you send it back, and the good just sort of flows, and it has a positive benefit all around. It's not a zero-sum game. It's very much synergistic. So with that, I think I'm going to pause, and I know we've been running over schedule. I've tried to stay a little bit brief, but let me just ask for questions, and since most of you have MBAs, if you don't ask questions, I'll probably call on you. So any questions that come up right away in terms of technology? I see one in the back. Hello, Senora.
Hello, my name is Daniela. I'd like to know if you are planning, if one of the companies is planning and expanding to Brazil.
Yes. By the way, can I just compliment your amazing Spanish? I mean, I just wish that I could speak as well as you do, as a Brazilian. So yes, many of our companies are already operating in Brazil, and many are operating in Latin America in general. Generally, the three big countries they go to first are Brazil, Colombia, and Mexico, for a variety of reasons you probably understand. Doesn't mean other places are not included, but it's just the kind of the easiest first to go to. Brazil is very attractive on the one hand, large market, advanced in many areas. Some of the difficulties we find are with bureaucratic red tape. There's a difficulty often in getting in, and you need to have sort of a local partner, and there's a lot of regulations of government bureaucracy that need to be overcome. For example, with banks, we have one company that is an acquiring bank called Credorax. They're operating in 34 European countries. They help merchants close the transaction locally. And it's good for the merchant because the transaction can be closed locally instead of being done transnationally. And when it's done transnationally, then the credit cards charge higher rates. So if you can close it in Brazil with a Brazilian bank, better for the merchant. This has been delayed a little bit by difficulty in finding bank license partners, but we're working on it, and eventually we'll get there. But I would say, it bears a longer conversation, but I'd say Brazil, super attractive for many reasons. We have Brazilian investors in our fund, and we're talking to some more right now that are thinking about coming in. And it's I'd say, still a country of the future, to quote a cliche, but it's still true. Yes, I see one more. Yes, sir.
David, I have a question
Please.
related to the companies that you invest in and you see. I must imagine that for every Facebook there must be hundreds of guys that try to make a Facebook, didn't make it, or same thing with Airbnb or Uber, whatever. And my question is, in your experience, is there a defining common characteristic that the companies that are able to actually execute upon the plan? Because I mean, they all had the huge addressable market, they all had the customer necessity, but only a couple really make it and grab 90% of the market share, right? So, actually, two questions here. One, what do you think are like the common traits that these companies had or the management had on the way? And second, I was just thinking about Uber and Lyft. Is it really that the number one player has the 80 or 85% market share and the number two is far behind, or is that more if you could?
Okay, excellent questions. I'm going to do two. I'm going to answer your last question first. Generally, I think there's been studies, probably at Harvard Business School somewhere, that the first three players sort of divide the market up, and something like 70% of the value goes to those top three. Like, what is it, 40, 20, 10, something like that. The top one gets 40% of the market value, next one 20%, and the next one 10%, and then the rest is the tail. And markets do concentrate. We're seeing incredible rapid concentration of markets because of the speed of access to the consumer today and to the B2B customer through SaaS. And that hasn't happened before. I mean, it's taken a long time to have large concentrations happen, but the speed of change is enabling that. Now, let me go to another question. You asked sort of what distinguishes the winners from the losers, and I'm not perfect at this. We try. We see 4,000 a year, and we invest in 12 or 15, and a certain portion of those 12 or 15 fail completely. I don't know, maybe 25% of the companies that we invest in fail completely. On the other hand, you only need a few like Nutanix, 50x so far, or Hootsuite, 50x, to make up for a lot of losers. So that's the exciting thing, that the upside is almost unlimited in venture capital. Downside, relatively limited, because you don't have a lot of leverage. We don't risk a lot of capital per each company. It's a couple $1 million, maybe maximum risk at the beginning. And the very important thing in venture capital is to minimize risk. People confuse the etymology of venture with like adventure. But the French translation is better. It's capital à risque, risk capital. And it is risky. We know we're in a risky business. So we try and not take extra risk. We try and avoid it. So the 6 things we look at when you say what distinguishes a winner from a loser, and I'm not saying we would have recognized Facebook versus, who was the other one? There was another one. What was it? MySpace, exactly, which was at the time much bigger and more successful. But the 6 things we look for are, we call them the 6 T's. And it's an easy mnemonic if you want to try and remember. First one is the theme. What is the big problem that you're trying to solve? And it should be a big problem. Don't just show us a feature, not a functionality, not even a product, not even a suite. It should eventually become a standalone company. That's the goal. So the theme, and say it clearly and simply. What is it that you're solving? And another friend of mine who's been very successful, he founded Waze, the company that does navigation. It was sold to Google for $1 billion. He says it's harder to find good problems than good solutions. So look for the really good problems, find them, go after that. That's number 1, theme. Next is the team. The team. Who's going to do it? Who are you, the founders? Why are you qualified? Do you have domain expertise? Even maybe more important, do you have persistence? Do you have grit? Are you going to stick with it to the difficulties? It's very much a roller coaster life as an entrepreneur. You get high highs, you get low lows. It's straining on the family, it's straining on your personal life. I think we're going to have a stress management section after this, so good. It's a stressful life, and you need to have grit. So the team, what are their characteristics? And one thing very important, don't try and cover it over if there's a hole in your team. If there are, say, 2 of you, one's a technologist, one's great on sales, but you have nobody in marketing or finance, don't say, oh, we have the great people there, and just put the names on. Say, we would also like help filling in the team here. VCs love to help on that. That's our job, is to help you. We know a ton of people that are looking where we can pull out of other companies and have you join your team. So the theme is first, the team is second. Next is the basically terrain, the market. What's going on? Describe what's going on in the market. Is there technological changes? Are there regulatory changes? Is it increasing demographic acceptance? Prices rising, whatever. How many competitors are there? What are your advantages? So theme, team, terrain. Then timing. How do you go to market? What's going to be your approach? Is it direct sales? Is it a channel approach? Is it on the web? Is it B2B, B2C? And then technology. How does it work? How does it actually differ from what other people do? And that's why we tend to favor at Blumberg Capital algorithmic companies, very intense, mathematical, powerful things that are a little bit difficult to copy or to utilize. Whereas other companies often are business model companies, where they're just taking a business model that they've seen works in Silicon Valley, and then they copy it for Germany, or they copy it for another country. We do less of those. We're more interested in what I think somebody talked about, first principles. No, again, Cuervo and Ms. Sanchez talked about first order inventions, where they can sell to the world. That's really what we're looking for. Sometimes we'd be open to you saying, gee, there's a huge Latin American opportunity. Bring such and such a model to Latin America. We'll start in X countries and move forward. That would be okay for us, but we generally like to see things that can go global. So more technology-oriented rather than business model. So I've gone theme, team, timing, technology, terrain, and then terms. How much money do you need to raise? Don't raise too much, don't raise too little. But most entrepreneurs tend to underestimate what they'll need. They tend to overestimate the speed at which they'll grow, the speed at which they'll be able to do business development deals. They tend to overestimate the way the market will accept their product. Almost every company that I know has pivoted once or twice before they really reach their successful model. And we understand that, and we're patient to a degree. We can't be patient forever. But so again, theme, what are you doing? Who's going to do it? The team. What's the terrain? What's the market look like? What's the timing of how you go to market? What's the technology look like? And what are the terms you need? And there are other terms beyond money. Sometimes it's very important for the founders to know a certain amount of control that they get said, or information rights, and those are different protective provisions which we negotiate. It's very complicated. You should always have an excellent lawyer who's familiar with the way Silicon Valley venture capitalists do deals. Some of the worst deals that I've ever seen have been where the lawyer comes from a completely different background, doesn't understand the way we're used to doing, and they're arguing over things that nobody argues about in our realm. And I think you understand the point. So specialty advisors can really help you a lot. Okay, did I answer those two? And then I'll just give you an example. I'm so fallible. I mean, I once turned down Palantir, which was enormous success now. And it was, at the beginning, it was 21 million in valuation. I thought that was way too high for a startup. It had no revenue. Peter Thiel, very famous investor, he's a friend, was begging me, David, I want you to know a lot about security. Come in, we're selling to the CIA, we're going to do this. And I said, oh, but selling to the government, it's so slow and it's lumpy. If you would sell to financial services, if you'd sell to hedge funds and financial markets, then I would invest. And he said, well, we don't know about that, we're not sure. Now, of course, they did that later, but their first big win was in the government markets, and they're now worth $20 billion. So we make mistakes all the time. It's worse to make one of those mistakes, missing a great company, rather than investing some that don't work out for the fund manager point of view, because we have about 30, 35 companies in each portfolio, and if we have 2, 3, 4 that are really strong, that will give us a nice 3x on our portfolio over time. Make sense? Okay, another question. Somebody hard question. Disagreement, yes. Oh, this man has experience in VC. Go ahead. All right, pin me to the ground.
Less about VC and more about the last part that you had your six squares about.
Yes.
How can Latin American or other companies work with Silicon Valley?
Yes.
I've worked with some of the media companies. They go to Silicon Valley. Sometimes they get the tour. You know, they get their pictures taken.
Yeah.
And they think they've got it, but it's
No.
much more. You need much more deeper knowledge, deeper connection. What are some ways that you've seen some
Yes.
good companies? And I've worked with David at Samsung, and we've done a pretty good job. But others, maybe from Latin America, that have really, or from other else, that have really, really embraced and been able to leverage
Yeah.
Silicon Valley for their own business, not just as a passive investor.
Well, it's an extremely good point. Rome was not built in a day, and a connection with high tech, called it Silicon Valley, is not going to be built by one visit. And especially if you go to Google and get a tour, and Facebook and get a tour, and Intel and get a tour. That's not it. It really needs to be much more relationships, and build them with one venture capital firm, 3 venture capital firms, other entrepreneurs you know. Many of you have brothers, sisters, friends who are at Stanford or places like that, or Berkeley, going to school. You know, go visit them, hang out, just listen to what people talk about in the cafeteria at the student level. That's a great thing to do. I'd say dealing with venture capital firms is an extremely productive way to do it, because we are, again, seeing many, many, many firms, and we filter. We have good pattern recognition, except for when I miss Palantir. But generally, we can help you avoid the worst things and wasting time, and help you figure out maybe some things that are oriented that we might invest in, but it might be perfect for you. So that's a thing that we like to do. A few other things, you know, you can also invest. You can invest in venture funds. You can invest in direct companies. Try before you buy. I'd say do it slowly. Don't put it all in at once. But I think it's important that you start playing. Again, the professor gave a great point. He said, doing first, and then how, and then why. You need to start doing the behavior, and then you start learning. If you're constantly questioning why, when should I do it, you probably never get there. So I think jumping in with a visit, and again, we're happy to host you for at least part of your visit, is a good way to start. But you need to keep those relationships up. You need to travel. You do. Much as internet is great, you have to be there and meet people and sit in coffee shops and come to our offices and sort of mingle around. There's a bit of schmoozing, is the right word, networking. That's part of this and keeping up. You can also keep up very well with a lot of the tech blogs, TechCrunch and Engadget, and there's a whole bunch of these groups that write about what's going on in the Valley. That's important. And you can find also specific blogs relative to your business that will talk about the innovations, maybe in the automobile industry, or if you're in telephone or in real estate, whatever it is. Change is coming, and people are starting to write about it. And I would say that you need to be watching and taking an aggressive, proactive stance. And I think your points are very well taken. It's not a one-point visit, tour, get a photo. It's relationship building that's going to take years. Okay? Yes, in the back I see 2 questions. First in the white shirt, and then the blue shirt.
Hello, Mr. Blumberg.
Hi.
Great talk.
David,
Thank you.
please. David.
Hello, David. I'm actually an example of your last question, of your last answer. I'm a Latin American that went to live to San Francisco for over a year, and I couldn't agree more with what you said. It's really worth making the jump to Silicon Valley and staying and living and experiencing life over there. With your experience looking at technology companies for, since the dot-com bubble years until today, what is your view on the new wave of Bitcoin cryptocurrencies? What happened with Ethereum lately? That it was like an IPO, right at a very extremely early stage of the organization running that particular cryptocurrency, having the whole market cap of Ethereum be worth from 18 million to $1 billion recently, and the rise of these new technologies are very interesting, and I think they have plenty of potential for developing nations, and particularly in Latin America. So if you can share some thoughts on that, that would be great.
Well, so congratulations that you did what I think many of you have done, is spent time, either school or work time outside of Latin America in, say, Silicon Valley or other places. I'm not saying Silicon Valley is the only place to go. There's a lot of stuff going on that's interesting in Austin, Texas, or in New York, or in Tel Aviv, or in Paris, London. There's and in Latin America itself, certain places have more going on than others. But Silicon Valley, there is something special about it. I mean, there's just, we don't have to say more. It's just true. Now, as far as Bitcoin and all that, let's start with there. This is a part of what I was trying to talk about, the virtualization of society and the virtualization, the dematerialization of industry. Remember that gold coinage and silver coinage, a lot of it came from here, from Latin America. I think, what do you call it? Worth of Peru, valor en Peru, was a statement in ancient Spain because there was so much gold and silver that came from Peru in the 17th century and so on, that it's fundamentally changed now. And value is no longer in those physical things, but more in electronic versions. The blockchain on which many cryptocurrencies are developed is the leading example of this technology. It's very exciting. It has a lot of promise, and yet it has enormous amount of problems. First, there's trust and criminality, and so a lot of governments were quite wary of it and blocking it and holding it back. And then there's its volatility. One nice thing about at least basic currencies like the dollar, and I know that's not perfect, but at least it's been relatively stable. And even though it's high now and it was low before and so on, nothing like what Bitcoin has gone through. So if you were looking for a store of value, Bitcoin has been quite a disappointment in most cases. On the other hand, the technology that underlies Bitcoin, which is just one, you can think of the blockchain as this electronic ledger on which we transact businesses which have reconcilability. That's not a really word in English, but they can be reconciled and traced and secure. On the other hand, the volatility of the pricing of any individual currency like Bitcoin or Bluecoin or Ripple or these other ones has caused a lot of people to lose money and be disappointed. I don't know whether it's going to work or not. I think the technology is intriguing, and something like it will work. I don't know exactly if it's going to be blockchain as we know it now or slightly evolved. And specific, I can't comment on the specific company. I don't know the case well enough. But I know that it's something for the future. It's something that's probably good in my view, because a lot of governments have done a very bad job, including ours, of managing their monetary and fiscal policy. And so inflation goes out of control, or et cetera, et cetera. I think most European and US and Japanese governments have done a bad job, and Latin America has also historically done a pretty bad job of managing currencies. And so something that takes power away from these governments and puts it more in a rational economic supply and demand market is probably a good thing, but it's just not ready quite yet. Okay? Second person back in the blue. No, not a question. You were pointing to him. Okay. I think we have one more minute, and if not, then we'll say, oh, here's one more. Yes, sir. You can just shout. It's a small group.
I wanted to ask, now that you are like Silicon Valley or Blumberg is looking to Latin America and talking about especially Mexico, I know that you can have like a great product, but you face a lot of things in, especially for example in Mexico, if you don't have like the right connections or something,
yeah.
Doesn't matter if you have a great product.
Yeah.
Sometimes you don't sell. So how do you face this since you're entering like this risk now in Mexico or Latin America?
Yeah. Surprisingly, you might think I'm exaggerating, but it's not that much different in the United States. Many of the entrepreneurs that come to us understand that the money we're investing is very expensive. Venture capital is extremely expensive for the entrepreneur. They give up a significant stake, maybe 10 to 30% of their company for our initial investment. That's a lot. But the value we add hopefully helps them grow faster than they would otherwise have done, and makes up for it in the end, as we talked about in Mr. Rivera's point, about an exit that is really mutually beneficial for us and for the entrepreneur. Now, without connections, the entrepreneur is often just a team of engineers. So what we try and help them do is find the right marketing folks, the right salespeople, the right partners, maybe who own companies like some of you, that would say, oh, let's take a technology. Somebody was talking to me, I won't mention the name, but a family here that owns a big retail chain, they found a technology from Israel with LED lights. And they're helping bring that technology to Mexico and then maybe to the rest of Latin America. Very exciting. That's the kind of thing we love to help our companies do. So you don't have to have all the right connections. You have to know how to ask for them, and you have to have something of value to deliver. And I'll just take one example of Israel in the 1 second I have left to show that a little tiny country can do great things. And many of your countries are far, far bigger than Israel. But Israel has come from deserts and swamps 50 years ago. Absolutely nothing there. The only thing they had was the people resource of their technology and their brains, and they worked very hard. And it was death or do. They had to survive or die. And so Latin America has both resources, natural resources, agriculture, beautiful climate, lots of people, etc., and far fewer wars than Israel's had to endure in its little lifetime. So if they can do it, I know Latin America can do it. It takes an emphasis on creativity, challenging, ask questions. Remember the part of the barriers that we face in Latin America? People are too accepting of hierarchy. Don't accept hierarchy. Question, challenge authority. That's the part of the Silicon Valley model that Israel adopted pretty well. And I think that the future is very bright. There are a lot of risks ahead of us, but there are also enormous opportunities, and those opportunities I think are far larger than the risks. So, suerte, carpe diem. Thanks.